All right, so today we're diving into the world of Benjamin Graham.
Oh, yeah. The OG of value investing.
Yeah, Warren Buffett's mentor. And his firm consistently beat the market for decades,
For decades.
with a 20% average annual return from 1936 to 1956.
That's insane.
Yeah. You've given us a stack of sources all about Graham.
A lot to unpack.
So let's see what we can learn and what golden nuggets we can find for you today.
Yeah, and you know what's so fascinating is that Graham developed these strategies so long ago,
So long.
in a completely different market era, but his principles are incredibly relevant even today.
They really are.
Like, he was so focused on the long-term,
Yeah.
steady wealth building rather than, risky get-rich-quick schemes.
Okay, let's jump right into some actionable tips then.
All right, let's go.
His first rule of investing is don't lose money.
I mean, that makes sense.
Sounds simple enough, right?
Yeah.
But how do we actually do that?
Well, this is where his famous margin of safety comes in.
Yep.
It's all about buying stocks below their intrinsic value.
Below their intrinsic.
Yeah, so think of it like you're buying a used car for $5,000, but it's actually worth $8,000.
Yeah.
So that extra $3,000 is your margin of safety.
Oh, I see.
Yeah.
So instead of chasing the latest hot stock or whatever,
No, wait.
we should be looking for those hidden gems that the market is undervaluing.
Exactly. And Graham actually learned this lesson the hard way during the 1929 crash,
Huh?
when he lost almost all of his investments.
Wow.
And it made him a staunch advocate for buying with a margin of safety
I see.
because it's a buffer against unexpected events,
Right.
and it protects you from potential losses.
So do you have a real-world example
Yeah, of
of
course.
how this might play out?
So let's say you're interested in Apple stock.
Okay.
Back in late 2018, their stock price plummeted, right? People
Yeah.
were panicking, but their core business was still strong.
Right.
So that dip actually presented a fantastic buying opportunity for anyone who understood Apple's true worth
Okay.
and bought with that margin of safety in mind.
So that brings us to Mr. Market,
Yes.
one of Graham's most memorable concepts.
Definitely.
It sounds like this Mr. Market was the one offering those Apple shares at a discount.
Precisely.
Okay.
So Graham personified the market as this emotional, unpredictable character called Mr. Market.
Okay.
And he's constantly offering to buy or sell stocks at different prices,
Right.
often driven by fear and greed rather than logic.
Oh, yeah.
Sometimes he's overly optimistic. Sometimes he's irrationally pessimistic.
That sounds familiar.
And your job as an investor is to see through his mood swings and capitalize on the opportunities he throws your way.
So how do we avoid getting swept up in his drama then
Yeah.
and making bad decisions?
So one way is to focus on those unpopular stocks.
Unpopular.
The ones that aren't making headlines,
Right.
but have solid fundamentals.
Okay.
Graham suggests looking for companies with low price to earnings
That's their earnings.
and price to book ratios.
Okay.
These are just fancy terms for comparing a company's stock price to its earnings and assets. Think of it like comparing the sticker price of a car
Okay.
to its engine size and features.
Gotcha.
Yeah.
But hold on for a sec.
Sure.
Let's break that down for our listeners who don't speak Wall Street lingo.
Of course.
What are these ratios actually telling us?
So the PE ratio tells you how much you're paying for each dollar of a company's earnings.
Okay.
So imagine two companies both earning $1 per share.
Okay.
Company A is trading at $10 per share, so its PE ratio is 10.
Gotcha.
Company B is trading at $20 per share, so its PE ratio is 20.
Okay.
Essentially, you're paying twice as much for each dollar of earnings with Company B.
Oh, I see.
Yeah.
So a lower PE ratio
Could indicate that a stock is undervalued.
compared to its earnings.
Exactly. Now, the PD ratio compares a company's stock price to its book value,
Book value.
which is like its net worth.
Oh, okay.
And a low PB ratio might suggest that a stock is trading for less than the value of its assets.
Okay, so it's like finding a house,
Yes.
selling for less than the cost of the land it's built on. Okay.
Yeah.
And the cool thing is you can actually find these stocks online.
You can.
Websites like FinViz have screeners that do the work for you.
Yeah, they're great.
You could filter for companies
Exactly.
with specific PE and PB ratios
Yeah.
within a certain industry.
Yeah. They're super helpful, these tools.
Yeah.
But this is just a starting point. You
Yeah.
know, you still need to do your homework.
Right.
Dig into the company's financials, understand their business model, make sure they have a solid track record.
So don't just rely on these numbers.
No.
To make your decisions.
It's just one piece of the puzzle.
Speaking of doing your homework,
Yes.
Graham was a big advocate for using checklists
He was.
to evaluate stocks.
Yeah.
He had his own detailed list of criteria.
He did.
But it was created decades ago.
It was.
So what parts of his checklist are still relevant for today's investors?
I think while some aspects might need tweaking,
Right.
the core principles are timeless.
Okay.
He emphasized factors like strong earnings growth,
Mm.
consistent dividend payments, a healthy financial position.
Yeah.
Like look at things like a company's debt levels,
Right.
their track record of earnings,
Yeah.
how consistently they've paid dividends. Those are still incredibly important.
So even though the market has changed so much since his time,
Dramatically.
these fundamental principles still hold true.
Absolutely. He also emphasized looking at a stock's current price in relation to its historical highs and lows.
Okay.
Is it trading at a significant discount to where it's been in the past?
Right.
That could be a sign of undervaluation.
Like buying a designer handbag on sale.
Exactly.
Okay.
Still high quality, just a lower price.
Interesting.
Right.
So we've talked about the margin of safety.
Yes.
We've talked about Mr. Market.
Yes.
Yes. And evaluating companies. But Graham also talked about different types of investors, right?
He did.
He had the defensive investor
Yes.
and the enterprising
The
investor.
rising investor.
Let's get it.
So this comes down to understanding your risk tolerance
Right.
and investment goals.
Yeah.
So the defensive investor prioritizes safety and stability,
Okay.
looking for steady, reliable returns without spending a ton of time researching individual companies.
Okay.
They might focus on a diversified portfolio of index funds and blue chip stocks.
Right. And the enterprising investor
Yes.
is someone who's willing to roll up their sleeves,
Yeah,
do more research,
exactly.
and take on more risk
Potentially.
for the possibility of higher returns.
With the possibility of higher returns. Exactly.
You're digging for those undervalued gems.
Yes, they're spending more time analyzing individual companies,
Right.
carefully constructing a portfolio based on their own research and insights.
Okay. I think I'm starting to get a sense of like
Yeah.
my own investor personality.
Yeah.
But what happens when Mr. Market throws a tantrum
Oh, yeah.
and my investments start taking a roller coaster ride?
That's where mastering the mind game becomes crucial. Graham understood that investing can be an emotional roller coaster.
Totally.
So he emphasized the importance of discipline and patience.
Oh, for sure.
It's about sticking to your strategy even when Mr. Market is tempting you.
Yeah.
With quick profits or scaring you into selling at a loss.
It's like being at a casino
It
with
is.
all the lights and sounds and
Excitement, yeah.
all designed to get your adrenaline pumping.
And make you act impulsively.
Yes. So Graham stressed the importance of having a plan
Yes.
and not letting your emotions dictate your investment decisions.
That's the key.
So instead of trying to time the market perfectly,
Yeah.
he was a proponent of dollar cost averaging.
Yes. That's a great way to remove emotion from the equation.
Okay.
So it's simply investing a set amount of money at regular intervals, regardless of what the market is doing.
Okay.
This way you buy more shares when prices are low,
Right.
fewer shares when prices are high,
Makes sense.
and automatically averaging out your purchase price over time.
So it's like setting your investments on autopilot.
Exactly. You're not constantly checking the stock ticker or second-guessing your decisions.
Yeah.
You just stick to your plan and let the strategy work its magic.
I like it.
And this approach can help smooth out the volatility of the market and potentially lead to more consistent returns over the long term.
Over the long term.
Yeah. And that brings us back to, one of Graham's core principles.
Okay.
Knowing yourself as an investor,
Right.
what are your financial goals?
Yeah.
What level of risk can you stomach?
Okay.
Are you a hands-on stock picker,
Yeah.
or do you prefer a more passive approach?
He even had a specific formula
He did.
for figuring out how much of your portfolio should be in stocks versus bonds based on your age.
Yes, he did, though. I think that particular formula is a bit outdated for today's world.
Yeah, probably.
But the key takeaway is to have a personalized plan,
Right.
a strategy that aligns with your individual circumstances and goals.
Let's get practical for a moment. If someone listening wants to start applying Graham's principles, where do they begin?
Graham always advocated for starting small.
Okay.
You don't need to invest a huge chunk of money right away.
Right.
Even a small amount invested consistently over time can grow significantly.
So pick a company you understand, believe in.
Yeah, one that you've researched.
Invest a few $100s and see how it performs.
Exactly. Treat it like an experiment.
Okay.
Apply Graham's principles. Do your research. Track the results.
Learn as you go.
This is how you learn and develop your own investment style.
There are tons of investing apps and robo-advisors out there now.
There are.
Are those a good option for beginners?
They can be helpful, especially for those who want a more hands-off approach.
Right.
But even if you're using a robo-advisor, I'd still recommend learning the fundamentals of investing.
Okay.
It's like using GPS navigation, it's great to have.
Yeah.
But it's also good to know how to read a map in case your GPS fails.
So don't just blindly trust an algorithm.
And understand what's going on under the hood, so to speak.
Precisely, knowledge is power when it comes to investing.
Right.
The more you understand, the less likely you are to be swayed by Mr. Market's antics or make impulsive decisions based on fear or greed.
Now, the intelligent investor.
Yeah.
It's considered the Bible of value investing.
It is.
But it's a dense book.
It is a dense book.
Many tips for making it through.
I'd suggest focusing on the core concepts first.
Okay.
Get a solid grasp on the ideas of margin of safety, Mr. Market.
Right.
And understanding the different types of investors.
Okay.
You can always revisit the more technical chapters later on.
And there are tons of resources online.
Oh, yeah.
That break down Graham's ideas into more manageable chunks.
Yes. There are even YouTube channels and podcasts dedicated to explaining his strategies in simple everyday language.
Yeah, for sure.
Don't be afraid to supplement your reading with these other resources.
Okay, so you've read the book.
Yes.
You're feeling inspired, ready to become the next Warren Buffett.
What are some common pitfalls that new investors should avoid?
I think one of the biggest mistakes is getting emotionally attached to your investments.
Okay.
Remember, you're buying a piece of a business, not a lottery ticket.
Right, so don't panic sell just because the stock dips.
Exactly. Focus on the long-term performance of the underlying business,
Okay.
not the day-to-day fluctuations of the stock market.
Gotcha.
Remember, Mr. Market is always there to test your patience.
And another mistake is chasing hot stocks.
Yes.
Right.
Those can't-miss opportunities everyone's talking about.
Exactly.
Yeah, the fear of missing out, FOMO, can be a powerful motivator.
Is.
But it often leads to bad decisions
Right.
and buying at inflated prices.
It's like trying to jump on a moving train.
Yeah.
You're more likely to get hurt.
More likely to get hurt than reach your destination safely.
Exactly.
That's a great analogy.
Thanks.
Stick to your strategy, do your research, and don't let hype cloud your judgment.
Didn't Graham also emphasize the importance of diversification?
Absolutely. Don't put all your eggs in one basket.
Right.
Spread your investments across different industries, asset classes, and even geographic regions.
Okay.
This helps to reduce your overall risk.
So even if one investment underperforms,
Yes.
the others can help to balance things out.
Exactly. Diversification helps you ride out those inevitable market downturns
Right.
and protects you from being overly exposed to any single company or sector.
Okay, so you've avoided the common pitfalls.
Yeah.
You built a solid, diversified portfolio,
Okay.
and you're seeing some decent returns.
All right.
How do you stay on track
Yeah.
and avoid complacency?
It's important to revisit your investment goals regularly.
Okay.
Make sure they're still aligned with your current financial situation and life stage.
Right.
Your risk tolerance or time horizon may have changed as well.
So maybe every 6 months or so,
Yeah.
take a look at your portfolio and see if it still makes sense.
Exactly. And don't be afraid to rebalance your portfolio if needed. If your stocks have grown significantly, you might want to sell some and reallocate those funds to other asset classes to maintain your desired level of risk.
So it's a marathon, not a sprint.
It is.
Investing is about building wealth steadily and sustainably over the long haul.
That's a great point. Graham believed in playing the long game,
Yeah.
not trying to get rich quick.
Right.
He believed that anyone, regardless of their background or income, could become a successful investor by following his principles.
Yeah, it's like building a house.
Yeah,
You need a solid foundation,
right.
and you have to keep maintaining it
You do.
to make sure it can withstand the storms.
That's a perfect analogy. And just like with a house, you need the right tools and resources.
Right.
And Graham wasn't afraid to use technology to his advantage.
Oh, really?
In fact, he was an early adopter of computer-aided stock analysis.
So even back then,
Oh, yeah.
he saw the potential
Absolutely.
of using technology.
To make smarter investment decisions.
That's pretty forward thinking.
Exactly. He recognized that technology could help level the playing field,
Right.
giving individual investors access to the same information and analytical tools that were once exclusive to Wall Street professionals.
Wow, so we've covered so much ground today.
We have.
If there's one key takeaway
Yeah.
you want our listener to walk away with,
Yes.
what would it be?
I think the most important thing is to shift your perspective on investing. It's not about becoming a part owner of great businesses
Okay.
and participating in their long-term success.
And remember, Mr. Market will always be there.
He will.
presenting you with opportunities.
Absolutely.
The key is to be prepared.
Be prepared,
Disciplined and patient.
and never stop learning.
Right.
The market is constantly evolving,
Yeah,
and your knowledge and understanding should evolve along with it.
that's great advice. I'm feeling inspired to go out and find some of those undervalued gems we talked about.
Awesome. I'm excited to see how you apply Graham's principles to your own investment journey.
Yeah.
Remember, the goal isn't to become the next Warren Buffett,
Right.
but to become the best investor you can be for your own unique situation.
That's a great point. It's all about finding your own path to financial success.
Exactly. And Graham's wisdom can be a powerful guide along the way.
For sure. And one final thought-provoking question for you to consider.
Okay.
Graham focused on finding undervalued companies
Yes.
in a time when information was scarce,
Right.
difficult to obtain
Yeah.
in today's world.
Yeah.
With so much data available at our fingertips,
At our fingertips.
how do you think the definition of undervalued has changed?
That is a really interesting question to think about.
It really makes you think about how to apply his timeless wisdom
Yeah.
to the modern investment landscape. There's so much to explore.
And that's what the deep dive is all about.
It is.
We're always uncovering new insights and challenging conventional thinking.
If you want to join us on this journey of discovery, be sure to subscribe to the Deep Dive. We have a whole world of sources waiting to be explored.